from the government and the stock exchange to boost shareholders' returns and boost profit growth. So many investors think that there will be more M&As, not just in car makers, but broadly in Japan, and that would be certainly positive. And machine tool makers are probably one of the most likely target of M&As because they're, generally speaking, their valuations are not that high. So this is going to have a huge impact on Japanese stock market.
All right, senior Asia stock reporter Hideyuki Sano there. Other corporate stories that we're tracking. Sources say Chinese toy maker Blox Group has increased its share offering and the allocation for retail investors after the IPO was almost 6,000 times oversubscribed. The maker of Ultraman and Transformers figurines is set to begin trading on Friday. We're told it raised $215 million in the IPO, with shares priced at the top end of the range. Defaulted Chinese developer Country Garden has proposed new terms with key banks that would slash its debt and lower borrowing costs. The company says the proposal would help it achieve significant deleveraging with a targeted debt reduction of almost $12 billion. It also proposed a debt maturity extension and asked for a reduction in funding costs. And another defaulted builder, Sunac China, has received a liquidation petition in Hong Kong. The city's judiciary website shows a winding up petition filed by China Cinda Hong Kong Asset Management, with a hearing scheduled for March the 19th. The case signals renewed financial and legal stress for the Chinese developer, which first defaulted on a dollar bond back in 2022. Let's take a look at how we're tracking here in Australia now. I've been going for a little bit more than half an hour, so a better read on where things stand. We're just higher by a few points. It was a down day for the ASX on Thursday. One standout, though, the materials sector performing pretty strongly, better by about 0.8%. If we take a look at Nikkei futures, meanwhile, setting up for a little bit of risk-off tone when we get going at the top of the hour. Still to come, JP Morgan, Bank of America and Citi have all quit the Net Zero Banking Alliance. We're going to unpack the implications with Environmental Advocates New York next. This is Bloomberg.
To the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Has the Fed decision under surveillance with the fastest coverage and exclusive analysis, including Powell's press conference. Nobody covers the Fed like Bloomberg.
Bringing you up-to-the-minute technology news whenever and wherever you are. I'm Ed Ludlow at CES in Las Vegas, and this is Bloomberg.
BlackRock says it's parting ways with one of the world's biggest climate investor groups, the Net Zero Asset Managers Initiative. The company says its membership caused confusion regarding investment practices and triggered legal inquiries from public officials. BlackRock had been targeted by Republican politicians for their efforts on global warming, accused of embracing so-called woke policies. And that follows the departure of Wall Street's biggest banks from a similar grouping known as the Net Zero Banking Alliance. Let's bring in Bloomberg NEF Senior Associate for Sustainable Finance, Mikhail Kishimoto. So, Mikhail, is this a signal that major money managers are no longer committed to climate actions?
Hi, so no, not necessarily. Under the influence of GFANZ, which is the umbrella group for the Net Zero Banking Alliance, banks are developing climate transition plans, which essentially outline their strategies on how they aim to achieve net zero. And also, GFANZ has been providing guidance with a set of elements that these transition plans should contain. Now, in our research, we have found that all of these banks that are leaving the NZBA in the US are doing quite successful in adopting the GFANZ guidance for transition plans. So, for example, they are publicly stating the types of products and services that they offer to support their clients' transitions towards net zero. Or they have also set their own interim emissions targets or their sustainable financing targets as well. So it is indeed a worrying sign that these banks are leaving the NZBA despite having done all of these groundwork for their transition already. But at the same time, this could mean that despite the absence of a formal commitment to net zero, these banks will be ready to continue to capture opportunities as part of the energy transition.
So what's the reason then for the banks leaving the alliance?
Yes, so banks and the industry are stating, as you mentioned, the mounting political pressure against climate-related initiatives in the US as the main reason for their departure from the NZBA. So, in fact, we are seeing more than 20 states in the US starting to introduce anti-ESG policies, which essentially prevent financial institutions from making investment decisions based on ESG factors. And this is in contrast to only about 7 states introducing pro-ESG policies, which promote sustainability. Now, another reason could be that banks are being placed in a difficult position where they cannot do everything for climate just on their own. So, for example, their clients in the real economy need to act, or projects need to be bankable from a financial institution's business perspective as well.
So how is this going to affect global energy transition goals?
Yes, so the energy transition in the US first will most obviously be impacted by the incoming Trump administration rather than by banks themselves. Also, in our research, we have also seen that close to $52 billion of green loans were signed in the US in 2024, which is a historical annual record for the nation. So this could actually be a sign that banks will continue to provide financing for green opportunities as long as they make a good business case, even though they might not make as big of a noise moving forward.
All right, Bloomberg New Energy Finance Senior Associate for Sustainable Finance, Mikhail Kishimoto there. Well, let's get some more on this with Vanessa Fajans-Turner, Executive Director at Lobby Group Environmental Advocates at New York. Vanessa, thanks so much for joining us. I just want to pick up on what Mikhail was saying there about JP Morgan, Morgan Stanley, Goldman Sachs, Citigroup's they're no longer members of the Net Zero Banking Alliance. What's your reaction to this? What are the real-world implications likely to be?
Well, first of all, good morning, and thank you so much for having me. In the U.S., we have a saying from a famous author, Mark Twain, who read his obituary one morning and said, "The rumors of my demise have been greatly exaggerated." This is not the end of climate finance, and it's not even the end of GFANZ or the NZBA. It is the result, as your previous commentator mentioned, of political pressure here in the U.S. There are going to be implications, as there will be from an incoming Trump administration. But fortunately, as I'm calling in from one of the states, New York State, that is pro-ESG and pro-climate action with one of the most ambitious climate laws on the books in the U.S., if not the world, there is much that states can do to continue endorsing, incentivizing, and supporting the global momentum towards a renewable energy transition, even while a Trump administration tries to dissuade it.
Well, if we take a look at the history of the NZBA, it was formed in 2021, but we have Bloomberg data that shows that since its formation, financing of the fossil fuel industry actually increased. So was there a degree of greenwashing going on here?
Certainly. There has been great increases, and the members of the NZBA certainly like to tout the increases in their green, so-called green finance, much of which was green, some of which was less so. But certainly not only did overall fossil fuel financing increase, but fossil fuel financing for things like coal, which is irreconcilable with any net zero goal on the books for GFANs, also increased among some of the key U.S. members in particular of the NZBA. So the degree to which GFANs members, NZBA members were using and abiding by climate goals simply because they were members is overstated. The degree to which they will still keep to their climate goals that they have committed to internally, or green hushing them, even if they are not promoting them in the ways they have been, remains to be seen. Do we hope they will continue to do the right thing? Yes. But it's also important to remember this isn't just about banks, and it's not just about climate change. This is about how financial institutions writ large are managing their risk and protecting the money that we're entrusting to them. Because whether or not they continue to abide by climate goals and mitigate climate risk, it's not going away. And we see that now as extreme record-breaking fires burn in California, and we see banks continually increasing their estimates of the damage these fires will cause day to day. JP Morgan today, just 2 days after leaving the NZBA, revised its estimate yet again for a second time, doubling its estimates of the damage to $50 billion just a few hours ago. And that's climate risk, real or not.
Well, we still have 80 banks remaining in this alliance in Europe, and the situation in Europe is somewhat different. The bank regulator there has just tightened requirements around ESG. So to what degree do you sort of see a two-tier system starting to emerge here? And what are the implications for climate financing, risk and profitability for US banks versus European banks?
This undoubtedly weakens U.S. leadership in global finance, and it leaves taxpayers and U.S. pensions and businesses vulnerable to not only unchecked climate risks and economic shocks, but discrimination from markets like the EU that have increasingly high standards and expectations about how businesses are doing their business, whether it is mitigating their risk or whether it is supply chain criteria that U.S. businesses are continually downplaying or ignoring. This is going to mean that not only is there a two-tier system in terms of high ambition and low ambition, but there's certainly going to be increasing global competitive edges to those who are being more out in front of the climate and renewable energy transition.
So you've just released your action agenda for 2025, and in it you say that the time for half measures is over. You're calling for more action. There are a range of policy responses you want to see in the US, but how much cooperation can you anticipate from the new incoming federal government? It might not be too sympathetic to some of your proposals.
I don't think we're counting on much support from the federal government that is coming in right now. The thing that we are noting is that New York itself has a great deal of not only symbolic importance as the epicenter of the global financial sector, with apologies to Hong Kong, but also to certainly with special authorities because of the geographic location, the tax base that many of the largest banks noted here today have here in New York City on Wall Street. And for that reason, New York State is in a very unique position to do some of the things that either federal government will not do and that banks will not voluntarily do. There are things like mandating emissions disclosures and climate risk disclosures, which we have seen become law in California. There are things like lobbying disclosures that will require banks and other financial institutions to be clear about the policies they are fighting or supporting. There are other types of financing conditionalities that we can explore. There are a number of regulatory notions that New York State itself can implement alongside other states like California. New York is itself the 10th largest economy in the world when compared with other nations. And California itself is the 5th. And in that way, these two states alone can account for a great deal of market leadership and sends very strong signals.
All right, Vanessa Fagians-Turner, Executive Director for Environmental Advocates in New York. Thanks so much for joining us. We have more ahead on the Asia Trade. This is Bloomberg.
The top names at the Fed are on Bloomberg.
The median projection is 2 rate cuts next year. That makes sense to me. But we have to remain agile. Every meeting is live from the standpoint that you're debating, you're discussing, you're thinking what's the right level of policy. But my projection is that it will take many fewer rate cuts next year than we thought. But I'll watch the economy and see if that works out.
Nobody covers the Fed like Bloomberg. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
Appolo Global Management says the lines between public and private markets are starting to blur as financing options grow. Co-President Jim Zelter told us exclusively how they're navigating this changing environment.
I think 24 was a pivot year. For us as a leading firm in this industry and in this sector, there was a great headline, and you and I talked about, the three of us have talked about on this show many times, where the great battle between private capital and banks. The reality is, if you look at the commercial dialogue going on between the top 5, top 10 institutions and the handful of us that lead our industry, the amount of integration, dialogue, working together on big deals has never been deeper. Obviously, there was our Citibank transaction, our Citigroup transaction, there was the transaction we did with Standard Chartered, BNP, and so I think we're still at the early days. These partnerships need to have substance. They can't be, excuse the phrase, shotgun marriages. They have to be ones that really have substance, dialogue, trust, and some history of doing a lot of transactions together. We've been fortunate in all the ones we've put together where there has been a lot of either history of personnel or of activity, but I think still it's early days, early innings. Now, there's a lot of headlines just to grab headlines, and there's not a lot of substance behind them, but I think that trend of private capital and bank partnerships is going to extend in 25 and 26. And I do think, if you think about the economic backdrop, I do sense that there is a great opportunity for strategic M&A. That clearly feels like it's going to happen. I'm a little bit more skeptical about the massive IPO window. If you look at the last 10 years, equity issuance has been about $250 billion, 50 billion IPOs, 200 billion secondaries. That's removing all the SPAC numbers. I think you still have a valuation issue with a lot of private equity companies that want to come out and do their IPO. And so I think we have a consensus view or non-consensus view at Appolo that number is going to be not as large as people think. And so the big mismatch, if you have a big credit market, a big equity market, this area of hybrid in between, which we've been talking a lot about, applying capital to those over-levered companies, that's the opportunity of 25 and 26.
5 to 10 years, will there be a difference between public and private markets?
We don't believe so. I think there will be some differentiations, and I think the question that gets raised right after that question that you ask is, well, is there going to be a massive compression in yields? And the advantage is going to go to those folks that have the bigger, you're going to make money on the origination. The ability to make the $3, $5, $7, $10 billion commitment to XYZ company, that's where you're going to garner the extra spread. But all the things that we're doing in origination, in capital formation, in trying to bring some liquidity to these markets in terms of secondary activity with transparency and price discovery, I think the barriers and what's private is risky and what's public is safe, I think those barriers will be coming down.
That's Appolo Global Management Co-President Jim Zelter speaking exclusively with our colleague Lisa Abramowicz. Okay, let's take a look at some stocks that we'll be watching when trade opens in Korea and Japan at the top of the hour. Seven & i in focus after the company's CFO said both buyout proposals on the table lack detailed information, and they're still considering all options. The company's operating income for the third quarter also missed average analyst estimates. And we'll keep an eye on Uniqlo owner Fast Retailing, reporting strong growth in the last quarter, except in China. Nippon Steel also on the radar. This is Bloomberg.